Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us today, author Bob Wiedemer. He wrote the popular series of books called Aftershock. This one's on the New York Times bestseller list, and here's his latest book, Aftershock Investor, and he basically tells you how to navigate what is going on because it is not over. Mr. Wiedemer, thank you for joining us today on USAWatchdog.com.
Well, thank you, Greg. It's good to be on.
Well, I got you as a guest because one of the people talking on mainstream media you were on, and they were saying, we've got a couple of years. You got, no, we don't. And they just kind of cut you off. And I think people are in denial when they come to the what's going on in the economy. And I just want to start off in your book, this chart about the money supply. And I got a couple of little things here. And this really shows to me that, the money supply going boom, parabolic, straight up there, just absolutely taking off right here, taking off. And it wasn't so much the bad economy, it's what they did to try to fix it. And we're still printing all this money, and everybody thinks that we're in nirvana, that it's over, things are done. Is that what you're seeing when you're out giving interviews about your latest book, Aftershock Investor?
Well, people are definitely in denial of what we're doing, and we always ignore that when they talk about the media. Nobody mentions the $85 billion a month we are printing now. They talk about how we might exit, but the reality is we talked about how we might exit all this money printing when we did QE1, when that chart was going straight up. And again, put that in perspective. That means we've increased our money supply about 300%. Before we even started this whole escapade of massive money printing, we'd only printed about 800 billion in the last 100 years. We're going to print more than that next year. So literally more than 100 years worth of printing next year. People just don't want to see it. They're hoping that it doesn't really mean anything, that it's all money from heaven, that it's not going to cause us problems. But I will say this, Greg, although people are a bit in denial about, how much government borrowing you're doing and how much printing, a lot of people do feel the effects of the bad economy. I was in Chicago last week, and one person asked a question, how do you feel about the recovery? And one person said what the whole audience felt is what recovery. So we're, not everybody's seeing it in their pocketbooks. I understand the stock market is up, but not everybody is necessarily in denial that we've got some issues left.
Well, I want to talk about, somebody wrote me today, I talk about this all the time, about the real estate market, and everybody's saying, boy, the coast is clear. And you address this in your book, The Aftershock Investor, the real estate market. And basically, the basic premise of your book, and I'm boiling it down in this section, is you should treat your mortgage as rent, because you're not going to get your money back. And people have never seen that in the real estate market. Explain that.
Well, basically what happens is, we've actually already seen it. Although we've had a bit of a recovery in some places on home prices, we certainly aren't up to our peaks of earlier. So people have still seen the value of their homes drop overall, even if recently they picked up. But fundamentally, this all depends on extremely low interest rates. And when those interest rates rise, the value of homes drop. And we're assuming interest rates will never rise. Well, when you printed that kind of money you're talking about, it's inevitable that interest rates will absolutely rise one way or another, through inflation or the Fed cutting back. And I think it'll be the Fed will keep printing, and it'll keep the inflation ultimately will push it up.
Well, so inflation's not going to save the homeowner, because as rates go up, the values will drop. That's what you're saying?
Exactly. So it's one of those situations, it's a stagflation type situation, is that the rates go up, that pushes the home value down. Now, at a high enough level, of course, nominal prices could go up a bit, but the value, the actual value, the purchasing power, so to speak, of your home will be going down.
Well, you were on recently and on mainstream media, which is why I wrote your name down and said, I got to get this guy. Because when you're ever on mainstream media, part of it is they're in half-hour block shows or hour block shows. You get 2 or 3 minutes. You're on with somebody else, and it's almost invariably the person you're on with says, oh, no, you're not right. No, that's not true. And you've got a runaway bestseller here with Aftershock. Hopefully this will be another bestseller. But they said something very interesting, and they said, we got another couple of years. And that's what I'm hearing, that, everybody's going to be able to get out of the stock market, and I'm going to get out and get all my money out, and I'm going to be first, and, that's all for the suckers that are going to be in there. And when they said there was going to be a couple of years, you quickly said, no, we don't. We don't have a couple of years.
No.
And that was the end of the interview, basically. Where are we timing Where are we timing out? Do we have a couple of years? And if not, how long do we have before the next implosion? And you're thinking that, according to your book, that, hey, you should get out of stocks and you should get out of bonds because the next crash is going to hurt hard.
The next crash is going to hurt a lot. And, I'm not going to say that we don't have more time left. Bonds are in a bad position right now, but they could come back a bit for a while. But ultimately, the bonds are going to be in terrible shape, and I think more people are recognizing that. Stocks, people are hoping that, this can go on, but we've already hit the stock market way up, way past what earnings are, and that's fundamentally a problem. In fact, if you go out to the next quarter, 80 to 90% of the companies projecting earnings coming up are showing negative outlooks. So that's why this thing could turn quicker than people think. They think that, as long as we're printing money, everything will be fine. Well, Japan just showed printing money doesn't always solve your problem. Their market's down almost 20% from where it was just a few weeks ago, and they're printing money like crazy. So be careful about thinking printed money is going to keep this up for years and years. It's not. Fundamentals really will matter. And printed money is, to a large degree, it's actually negative. It's just right now, psychologically, we're seeing it as positive, but that psychology can change. And clearly, the underlying earnings are not there to support a market at this level. I mean, think about it. Is this economy anything like what it was in 2007? And when the market was 1,000 points less? Don't think so. 2007, things were really rocking. They're not anymore.
So how much time do you think we have? Do you think that things falls out of bed between now and 14? So we don't have 2 years?
Between now and 14, I think you're going to fall out of bed. Absolutely. Is the entire aftershock going to hit? Probably not. So in that sense, this is a long process. And, but fall out of bed before 2014? Yeah. Mm-hmm.
Yeah. You think the stock market will crack before 2014?
Absolutely. Now, it could crack in a couple of parts. It could go down. Fed could come in and try to save it. But again, I don't think we're going to be able to reinflate it. It goes down, and then maybe everybody stabilizes, and maybe you get a little bit of a bounce, and then ultimately, it's, when it finally does go, it's like a cliff. Because if just what you said is everybody said, well, I can get out ahead of everybody else. Well, let me tell you, when, everybody says they're getting out, nobody's getting out. You can't all squeeze through the exit door. And that's been true, whether it's the internet or housing, anything. When everybody tries to get out, it's done for you. Nobody gets out.
So what does the next aftershock, what does it look like when it's in full bloom? When everybody wakes up and says, wow, things are bad, how bad is it going to be?
Well, part of the problem it gets bad is because the whole world is in on this to a large degree. I have a chapter in there called The World's Bubble Economy. So that's part of what's actually hitting us now is the rest of the world, particularly China, is not helping boost us up. So when it goes, it's a worldwide issue. And the U.S., we may not be the driver of the world's economy anymore, although we're very important, but we are the driver of economic stability or economic stability. If we have trouble, it's going to reverberate through the rest of the world, and then that's going to, kind of have an interactive effect on our stock market. The big effect is on asset prices. Not saying the economy won't be affected a lot, but asset prices are what can most easily be affected, stock and real estate and bonds. That's what gets most affected in the aftershock.
So how poor are people going to be? I mean, if you got $400,000 in your 401k, are you going to be able to get to that? Are you going to be able to spend that?
Well, that's the problem. If everybody's trying to cash out, it doesn't work, does it? And again, you can talk about a big decline in the stock market, but, I growing up in the 70s when the stock market was 800, 900. We weren't that poor. People have just gotten used to a very, very high level of return on assets. It just doesn't make economic sense. I mean, houses were a lot less expensive in the 70s. I don't think we were all poor, but asset prices weren't where they are. So can people sort of avoid saving to have retirement come from just massive growth in stocks or houses? No. Are we going to pay a penalty for having run up these big bubbles? Yes. Fundamentally, we're going to get through all this. Economically, we'll come back. But, I can't tell you that high asset prices are coming back because, again, they've really got to be tied more to economic growth. And, frankly, economic growth is 2% this year. If productivity grows 1 to 2% a year, that's pretty good. So we've had a very unusual period of this explosive asset growth. And, that's what people are worried about losing. It's not that the whole economy collapses. It's just those assets can go down in value. So, no, you can't necessarily exit your IRA. You may have a very big hit if you wait too long, a very, very big hit.
Like 50%? Like 80%?
Like 50% or more. What was I told? What was it in the 70s? It was 1,000. Could earnings go back down to those levels? Or absolutely. We could see right, stock prices go way back down to where they were before the bubble started inflating in the 80s and 90s.
You saying the stock market could go to 1,000 instead of 14,000 or 15,000?
It could, and that's part of the problem, is that so much of this is based on the fact that it's always been going up. When it starts to go down, and fundamentally the bubbles that we've been using to pump this thing up, the government money printing, the government borrowing, don't work to keep the bubbles up anymore. It becomes that vicious cycle again where everything starts working on each other and it all goes down. And when people lose confidence, that's a problem. That doesn't necessarily stay down there. Not necessarily. It could be a buying opportunity, but when people lose confidence, they get scared and they all tend to get out. And the problem is they can't all get out and you lose buyers. You just don't have a lot of buyers at that point because they've sort of lost faith that this is an easy, simple way to make a lot of money fast, and it's not. And so for a while, you could take a very big hit. Yes, well over 50%.
I always like to use my if he's half right measure, and if you're half right, you're talking 7,500.
Absolutely.
I mean,
it's just one of those things that's
a lot.
Hard to control. Yeah, it's one of those things that once it gets going down, it's hard to stop. And so what we're doing is trying to pump everything up high, but once that pops and it doesn't work anymore, you're back to fundamentals, and fundamentals simply don't support this kind of market anyway.
You wrote this book with your brother. I think it's your brother, right?
Yes,
Dave.
it is.
And he's got a PhD in economics, and you have an MBA. You have a master's in business, and then Cindy Spitzer, who is also another writer on this book. And none of you guys are gold bugs, are you?
No. I mean, I'll be honest. I'm a coin collector. I've been a coin collector since I was a kid, but not a gold bug. I only started investing in gold back in around 2000, 2001. Started making my first moves into it. Didn't buy it earlier, so definitely not gold bugs. Coin collector, yes.
Well, you have a chapter here, and what I find from the people I interview is when you look around the landscape, where's that 10% bond, or where's that sterling stock, or what brokerage would you store all that in that could go under? And here you talk about gold and the once and future king, and you talk about basically getting physical metal. Why?
Well, I think there's two aspects to that. One, I think gold is, and it's not just I think, it's true, it's not very interest rate sensitive. If interest rates go up, what happens to bonds, real estate stocks? And that's just something you learn in basic finance courses. And gold is not. Gold's really the opposite. As an interest rate inflation goes up, gold does very, very well, particularly if other asset classes aren't doing well. People tend to move towards it. Right now, there's a little less fear in the market, so there's less interest in gold. But that said, over a longer period of time, gold's still up almost 400% since 2000, whereas the S&P, has barely risen 5 to 10% since 2000. Adjust for inflation, it's still negative. So stocks over that period of time since 2000, since the initial kind of bubble stopped rising, really haven't done that well. They've been able to get back what they've lost, but that isn't really where you want to be in investment. Gold's actually done very, very well. And that's during a period where it's just isn't really that good for gold. I mean, inflation hasn't been that high. Bonds have been, not bad. Stocks have been okay. What if that situation changed and you had big problems with those other markets and you do get some inflation? If gold can go up 400% during that period when it wasn't so good, what if it changed? How much could gold go up then? So I'm bullish on gold long term. I recognize right now it's out of favor. It may stay out of favor for a little while. That's, I think, a buying opportunity, but doesn't mean it can't go down from here a bit. But overall, long term, I think it's going to be a good investment. And I do think there's also a bubble element to gold as well, and there will be a time to exit gold too, but not for the next few years, certainly.
Not for the next few years. What do you think the price of gold could rise to?
Well, as I said, it's already up 400%, in a relatively, negative market for gold. It could easily go up another 400% in a positive market.
400% times 4, you're talking 6,000-7,000.
6,000-7,000.
Wow. One last question for the people out there. If they don't have enough money to buy gold, if they don't have enough, money to, they're poorer, what are some of the things they could do to try to protect themselves for this crisis that's coming?
Mm-hmm. Well, just be careful not to get yourself too exposed. If you don't have too much money to invest, whether it's bonds or stocks, then that that's you're not going to be too exposed. Treat things seriously. Save some money. Most people can buy a little bit of gold. Silver is a very volatile metal, so I'm not thrilled with it, but I think it will go up long term. It is cheaper and easier to buy. But just, basics. Be careful what you spend. don't think that everything goes on good times forever. So many people are living to paycheck. I was just speaking with a woman who we were talking. One of the key things is just to save a bit. They're just not used to it. Save a bit of money, and then just be careful in your lifestyle, which is not what's in vogue today. That's for sure. It's $400 purses and $300 shoes that it's in vogue today. But I'm saying this is the kind of thing you should be careful about, especially if you're living to paycheck.
And finally, when is the next Aftershock going to fully, absolutely take hold? What's your prediction by what date that you think, wow, it's hit?
By the latest, within 5 and 6 years, fully take hold. Fall out of bed by 2014, quite possible. It's hard to get a perfect prediction on this. I'm not Nostradamus, but, that's sort of what we're seem to be heading towards. But 5, 6 years, that's the latest for the full Aftershock to hit.
But there's no getting around it. There's no, they're going to do something. We found shale up in North Dakota. We invented a new iPad. That's not going to help us.
Yeah, no, I mean, it all will help. Obviously, shale's going to help North Dakota for a while, although, frankly, the drilling increases there have stopped. But, it's still going to help. A new iPad hopefully will help Apple. But you've got a much bigger, more fundamental issue with your economy, with productivity not growing like it did in the 50s and 60s. Our economic focus has been on building bubbles, not building productivity, not basic economic growth. And that's really been the issue. And that involves very much a governmental issue. It involves a lot of things. And that's hard to change overnight. And an iPad won't do it. Might help Apple, but, it's part of the stock market too, as it's found out. And unfortunately, it's much more fundamental issues we're dealing with longer term. Short term, obviously, things can get, in certain areas good or bad. But longer term, it's very fundamental.
Bob Wiedemer, the author of the latest book, the latest Aftershock book, The Aftershock Investor. Mr. Wiedemer, thank you so much for joining us today on USAWatchdog.com.
Thank you, Greg.